Mark, take on the week, and was PPI yesterday something of a game changer?
I think, first of all, this week has reaffirmed that probably the big theme for the next 6 months is inflation. It's not just about PPI. The details in the CPI were also not encouraging. It's just because we didn't get a really scary print that there's a bit of relief in market. But the reaction in front-end rates to CPI was more about the pressure that we got from Bessent and this administration on the Fed and what's happening there. But that, again, is inflationary. So the key takeaways are both CPI in the details and the PPI show that tariffs inflation is coming through, and we're going to have more inflation coming through naturally from the trade policies that are happening from the US government. On the other hand, we're also getting pressure on the Fed to have easier monetary policy than would be justified by orthodox economic theory, which is also inflationary. So the big takeaway from this week is that inflation is coming to the US. You want to buy assets that will hedge against inflation, and you also should expect a steepening of the yield curve, with long-end bonds ultimately suffering over the coming 6 months or so, or maybe longer.
Talk to us about that margin pressure question, though. I mean, we just had a guest on that talked about the PPI data being a canary in the coal mine. For how long? When do we see the actual effect of that on corporate earnings?
Yeah, absolutely. What we're seeing now is companies are not passing on to consumers yet. And we've talked about this a lot the last month or so, that essentially because the stop-start nature of tariffs and the fact that there were so many tariffs that are imposed or later revoked, it does not make sense for companies to be premature in acting. They want to wait as long as possible. And because we've known this tariff story was coming for a long time, it was well flagged, people have been able to front load on their supply chains. They've bought time to delay reactions. That means that I was expecting that we'd see companies start to react by the end of third quarter, so we'd see it in those kind of earnings that come through in 3 months' time. In fact, when I wrote a piece on this a couple of weeks ago saying that's the rough timeline, most equity PMs wrote back to me and said, no, it's more likely in fourth quarter that we'll start seeing the pass-through to consumers. Ultimately, it will all be passed on to consumers because there's no competitive advantage to taking on the pain given that tariffs are everywhere. So it'll all ultimately be passed on to consumers, but we'll only really start seeing the severe impact of that in the fourth quarter in pricing, which means it'll be in the earnings results that we get in January.
Mark, I want to ask a question on your thoughts on this summit between Trump and Putin happening in Alaska today. How are markets playing this?
I think that overall expectations are very low. There's very little probability priced for a positive outcome. And therefore, I think there's a greater reaction if there is any positive outcome. I think a very positive outcome, like some peace deal framework announced, is an extremely unlikely tail risk. But I think there are various other headlines that don't result in oil higher, don't result in secondary sanctions, that will ultimately be seen as being a risk on and a positive for markets.